Good morning, everybody. Lauren Moon and Don Garman are here checking in with you. We just got out of our Tuesday investment committee. We had some interesting discussions. Jonathan went over a lot of kind of market technical moves that have happened in the preceding weeks. We had some interesting debates on kind of sector diversion and how different sectors within the market have performed, and what our outlook is on those going forward. So interesting day today. Don, what are your takeaways you think we should share?
Well, hello, everyone. I would say, I guess directionally, a few things have changed in the last couple of weeks, right? The Fed, which starts its two-day meeting today, so they'll do their announcement tomorrow at 11:15 or whatever, has basically signaled, interest rates are going to be low, near zero for quite a while, perhaps 3 to 5 years, maybe longer. And they are obviously feeling like they have to do that to, force people out the risk curve into, the markets to, in pursuit of some kind of a return on capital. And that is a better, outcome than everybody hoarding their cash and the economy, which is obviously certain segments of it continue to be shut down. They're viewing that the, kicking the can down the road to be a more attractive path than the sort of certain doom of not doing that, and having those of us who can keep a lot of cash and get a return on it going that direction. So I think that's important, because I think that's what's been the last breath of wind in the sails of the market is, okay, so, zero rates are here. So it makes bonds or treasuries unattractive, cash yielding zero is unattractive. And, you can still get 5, 6, 7% yields from equities. And so I think people are forced to have to embrace that. If you are a portfolio manager who is paid in essence to go seek a return on your investors' capital, you've got to sort of play that game. And we've done that. And, but we do it in a slightly, I would say, more balanced or conscientious, or, I would say, we don't tend to play in the hottest segments, because this has been a very strange period for certain segments of stocks have been decimated and are still down 25 for the year. And other segments which are viewed to be, sort of the beneficiaries of COVID, have done well. And we own some of those. But I think the game now, which I find to be very interesting, is everybody who's playing that game is playing it with the belief that they're going to be the ones that get their chips out and off the table before somebody throws the table over and everybody gets destroyed. And having been around for 28 years and lived through the tech wreck one and financial crisis, I know the myth of being the smartest guy at the table who's able to win and get your chips out before somebody tosses the table over. It's so painful and so fast, and it's too late when the table gets tossed over to get your chips off, that you gotta, for us, for the core of our business, have to play a more rational, long-term, measured approach, which is what we do. So how was that for
That's great.
Filibuster?
Well, one of the things you reminded me of that Jonathan went over that stood out to me the most is how VIX, which is a measure of volatility, is low now after last week's moves.
Lower, but not as low as it was 9 months ago. Yeah.
Right. And that general overall liquidity in the market is very low.
Super low.
So there's basically not a lot of trading, and people are not feeling as much uncertainty as they were earlier in the year.
Fear, I would say, directly fear.
Not uncertainty. Yeah. So it's a little bit of an interesting time. I feel like people are just kind of waiting to see what happens next with the election. They're not really wanting to play their hand in any way, shape, or form right now until we have more news. So it'll be interesting.
I'll do my quick little screen share and again, we're not huge fans of looking at the Dow as a measure, but it is popular still and people still do look at it. But I decided to throw up the S&P 500, which is blue, the Russell 2000. So this, a way of thinking of this, and you guys have seen various variations of this through the years, is US large cap and US small cap. So if you take the Dow, which is down a little bit in the red, out of it, and just average 105 and 93 and add them together and divide by 2, then you're going to come up with a number just a little bit under 100. So this is exactly what you're talking about. Max fear, economy shut down, and then liquidity, which is kind of, I mean, I think it's naive to think that everybody can now look back and say with perfect foresight that everybody was going to decide that, tens of millions of Americans or 10 plus million Americans unemployed and hundreds of thousands of COVID deaths would translate into a fairly innocuous market reaction.
Mm-hmm.
Seems clear now in hindsight, not so clear looking out the windshield, but we're relatively happy because I think as much as anything, our clients appreciate stability and the ability for us to adjust and adapt. So one of the things I do think is important is the complexion of the Longview strategy, the flesh and bones of it. It does look a lot different, right, than it did 9 months ago. And I think it does indicate for us some, I do think it's going to be a long haul for a lot of these companies that have had to take on lots of debt to get through this period. This is unfortunately the condition of the world where this debt either has to be inflated away, defaulted on, or repaid or refinanced. And so I think it's like state of California is an interesting example. Like we've refinanced a lot of, this with munis. A lot of the muni bonds that have rolled off that were paying 3.5% to 5% coupons are now 1s and 1 1/4. And the U.S. treasuries that were issued 30 years ago were yielding 5.5 or 6. They're rolling off and coming back into the market at 1.5 or 2. Mm-hmm. So and my own mortgage, as we indicated last week, and you as well, I never thought I would see a rate lower than I saw in 2016. And now that's been lowered. And I thought it was very interesting. Schwab today, the company, indicated their quarter is not going as well as they had hoped. Why is that, you ask? Well, because people are repaying their mortgages. So the yield, the mortgages that sit in those securities that were 3.5 to 4.5% mortgages are coming back in at 2.5 to 3. And so the yields are going down. So the amount of money they make on those holdings that they have is going down. So it's, we're sort of continuing to squash down the trampoline here, and, we'll see where it all ends. But anyway, that was a lot in a short amount of time. So sorry about that.
All right. Well, I think we'll leave it there for now. As always, reach out if anybody has any questions. If there's specific items you want us to address, we'll do our best to get to them next week. Or
I would leave it on this note, which is, over the last 2 weeks up until yesterday, we had been in some kind of a give back mode. Certainly the hottest stocks in the market, had been, pretty brutalized in a short amount of time, and they're stabilizing and recovering now. But we're sort of halfway between where we were and where we were a few days ago. And kind of we're in that, in that gray area in between. And so we're sort of happy and content with our asset allocation and our selection and the individual selections that we have. And so, there's not a lot forecasted that's going to be a radical shift off that. A lot's going to have to do with the outcome of the election, and is it all, is there any major surprises? And we have kind of an idea of what we'll do in either case. But I think now we're in that window where we get to watch debates and get to see the animals fight in the cage, which is not going to be particularly enjoyable, but it will happen.
Yep.
So on that cheery note.
All right.
Thanks, everyone. As always, reach out if you've got anything you want to talk about. Thanks. Bye.
Bye.